Well, I'll go ahead and get started. Today, we're gonna talk about depreciation. And I ain't gonna lie, like putting this together, I had to take out a lot of slides because I felt like I was talking, it was getting too technical. I was getting into the weeds. And I just felt like for a class like this, I wanted to keep it more high level. Because there's a lot of stuff you can get. You could really go down the rabbit hole with this stuff. And I didn't want to do that because I feel like all it's gonna do is confuse people. So I'm gonna try to keep it as high level as possible. I ask that you hold all your questions to the end. Just let me get through these couple slides, and yeah, then whatever questions you have, I'll go ahead and tackle it at the end. But let's go ahead and get started. I've taught a couple of times since the summer. So, but just, that's a little bit about me. I own and operate a real estate brokerage. That's my primary, source of income. I'm located in the New Orleans and Baton Rouge areas. So I'm from New Orleans, born and raised. So yeah, real estate investor, and I do lend money out of my self-directed IRA. If you want to, talk to me after this, you can definitely reach out to me on Instagram. That's my preferred method of contact. And you can see that on the screen, Cousin Sales LA. That's my name on there. And I just started a little YouTube channel, you know what I mean? So you could subscribe. Ain't got nothing good on that yet, but it will be. It's coming. And then if you ever, interested in purchasing property down here, that's my website. So enough about me. We always got to start with a disclaimer, especially when we talking this kind of stuff dealing with taxes. So this presentation is for your enjoyment purposes only. Anything you hear today should not be taken as financial advice. Please consult your accountant. I always say this, look, I'm just a little dude from New Orleans with a little bit of knowledge. So, and I'm trying to get that knowledge to you today. So here's the agenda. Back in June or July, I don't remember which one, I had presented and talked about the 5 ways that real estate pays you. So I'll do a brief little recap on that. Then I'm gonna talk about what is depreciation, how it's calculated, how you can utilize it, and then give you a strategy to never have to pay taxes on capital gains. So just a recap of the 5 ways real estate pays you. Everybody's, I'm pretty sure, familiar with cash flow. That's all your income coming in minus your expenses. Whatever you have left is your cash flow. That's probably the primary reason why a lot of people get into real estate investing. The second one would be appreciation equity capture. As you know, over time, property values go up. So you taking advantage of that appreciation. And then as your tenant is paying down your mortgage, they're also paying down a piece to your principal. So you're capturing equity. Leverage. I always say this, if you want to buy real estate, you don't have to have 100% of the funds. The bank will always be able to lend you money on that. So at worst case scenario, you're putting down 25% to acquire multifamily property. The bank's going to give you 75%. And you get to eat in all the benefits, like depreciation, which we're going to cover today. The bank doesn't get to recoup that. You do. So that's why it's highlighted in yellow, because that's what we're going to spend our time on today. And the last one is inflation profiting. So essentially what this is you're locking in long-term debt with low interest rates. So for instance, I have a loan, just locked in something this year at a 30-year mortgage at 3.75% interest. 10 years from now, the bank's not going to come back to me just because interest rates are going to be most likely going to be higher at that time. They can't come back to me and ask me to increase my interest rate or pay them more than what we agreed to. So you're locking in a 30-year note. If my mortgage is $1,000 a month, 10 years down the line, 20 years down the line, they can't come back to me and say, I want more than 1,000 because I locked in 1,000. And I'm paying it back with cheaper dollars because as you know, the dollar is going down in value. So 10, 20 years from now, I'm gonna be paying that same $1,000 a month with cheaper money. So that's what inflation profiting is. So what is depreciation? A few of these slides, I'm kind of gonna read you the definition and then I'll break it down. So depreciation allows you to deduct the cost from your taxes of buying and improving the property over its useful life, and thus lowers your taxable income in the process. It begins as soon as the property is placed in service or available to be used as a rental. So some key numbers to remember when it comes to residential, and you see on here is, a fourplex and down, is 27.5 years. When it comes to commercial, that's 39 years. So when I say commercial, I'm talking a fiveplex, I'm talking a 300 unit apartment complex, office, industrial, like whatever that's considered commercial is depreciated by 39 years. So that's two key numbers to remember. So according to IRS, you can depreciate a rental property if it meets all of those 4 requirements on the screen. Pretty self-explanatory. You own the property, you use it in your business or as an income producing activity. The property has a determinable useful life, meaning it's something that wears out, decays, get used up, becomes obsolete, or loses value from natural causes. And the last one here is just the property is expected to last for more than 1 year. So essentially, the IRS allows you to depreciate properties because they do, they wear and tear over time, the structure at least. So how is depreciation calculated? So you have to determine the basis of the property. Basis is just a tax term. I'll break it down on the next slide, but you determine the basis of the property, then you separate the cost of the land and the building. So you can never depreciate land, only the structure. So remember that. And then, after you separate the cost of the land from the building, what's left over is your basis in the property. So when it comes down to taxes, you're going to want to know what your basis is. And I'll explain that right now. So basis is the cost or the amount you pay to acquire the property. It can include some settlement fees, closing costs, legal fees, recording fees, a bunch of fees, basically like your closing costs. So whenever you're trying to figure out the basis in the property, I would get with your accountant to do it. But essentially what they're going to need is your settlement statement. So they'll see the purchase price plus the fees you paid to help you determine what your basis is in the property. And that number will change every year. So let me show you how it works. So here's how it's calculated. We're just going to use an example of just a $200,000 residential purchase. So you purchased the property for 200, you had 5,000 in closing costs, so you're all in at 205. So remember, that's the original basis. So then you have to take out the cost of the land. So the value of the land. So if the land in this case is worth 30,000, you take that out and you're left with 175. So that's your original basis in the property, or that's your basis in the property, 175. So then what you do is divide it by 27 and a half years because it's residential. And the number you get is the amount of depreciation you get to claim every year. So in this case, we got 6364 each year. What does that mean? That means that $6,364 of income that you receive from the property is tax-free. You don't have to pay taxes on that amount. So let's say, for instance, I made $7,000 in cash flow from the property for that year. Well, I would only have to pay taxes on whatever the difference is. What, $636? Whatever that 7,000 minus 6364 is what you're paying taxes on. That's how depreciation works. It allows you to not pay taxes on the amount that you're depreciating. So let me break it down even further. So in that same example, remember I was saying you have to track your basis. And this is done on your actual tax return. Each year, your accountant should be keeping up to date with this on a specific form in your tax return. But each year, you're going to deduct that 6364 that you're not paying taxes on. So in this case, we started with the 175, which our original basis was at the purchase. And then each year here, you just see all I'm doing here is just deducting 6364. It's important because the IRS wants, they're going to want their money. So I'm telling you that you don't have to pay taxes right now on it. But if you decided to ever sell, this is how they determine your capital gain. So let's say after year 10, properties went up, property values went up. You bought it for 175, it's now worth 250. So you want to sell it. But remember, we then took $63,640 of depreciation over those 10 years. All that is the 6364 times 10. So that $63,000 is what we did not pay taxes on at all during that 10-year period. So the IRS, they're gonna want, it's something called depreciation recapture. So essentially what it's doing is when you go to sell this property, they're gonna take whatever you sold it at minus whatever your basis is at the time. That's why this is being tracked on your tax returns every single year. Your accountant should be updating this amount every year. So instead of you thinking that you would only have to pay taxes on 250 minus the original 175, and that would have been a $75,000 gain, you actually paying taxes on 138 because you never paid taxes during those 10 years on this amount. So they want to recapture that depreciation. So keep that in mind. That's important to know, rental owners, you know what I mean? Like to make sure you're not getting a bigger tax bill than you think you are. So just make sure whoever's doing your accountant, whoever's doing your tax returns, is making sure they're tracking this basis because this is important. You absolutely need this. And if you own properties already and you have not depreciated the property, it's not too late, but you definitely need to get that fixed right away. And also a question I know y'all gonna ask me at the end is, what if I own a duplex or a multifamily property? So if you do, you still can depreciate it. You just cannot depreciate the part you live in. So that's where you would need the accountant or CPA, somebody to help you figure out that what the taxable amount is. So essentially the part you live in you cannot depreciate, but the part, you rent can be. And it gets a little complicated. So make sure you talk to somebody. Here's the good part. So when it comes to commercial, remember I was telling y'all it's 39 years. So let's do an example. $2 million purchase price, $20,000 in closing costs. The land is $200,000. So we're gonna take the land out of there and we're left with 1.82. Divide that by 39 years. You write off the first $46,000 in income, or cash flow, I should say, for the year. You don't pay taxes on it. It's pretty good, huh? But there's something even better. And I'm about to open your eyes up to this. Something called a cost segregation study. And this is why you see a lot of like the big dogs going out and buying these large commercial properties and apartment buildings, is because they can write off so much in depreciation. And let me show you how it benefits you as the owner. So a cost segregation study, basically, I ain't gonna read all this. Essentially what it's saying is that it identifies personal property and reclassifies it to allow for bigger amounts of depreciation. So instead of you taking, like in that example, I think it was $2 million or 1.82, instead of doing that divided by 39 years, because it's all about the time value of money, right? Money today, the money in your pocket is worth more today than it is tomorrow. So instead of you just taking the total amount divided by 39, what they do is they break it down into individual buckets. So they may say, well, the landscaping, it doesn't have a 39-year life. The cabinets don't have a 39-year life. They have a 5-year life or a 7-year life. The toilets. So you have to hire a person that specializes in this, and they will go through and they will break down every single component of that property and put it in the correct buckets. So what it's doing is it's allowing you to take a bigger amount of depreciation up front. So let me show you an example. In this first column here, this is before cost segregation study. This is just saying straight 39-year depreciation. You can see in the first year, this person would have been able to write off $128,000 in depreciation. However, when they employ a cost segregation study and every component is broken out, they're able to write off $893,000. That's the biggest difference here. And that's why you see people like the former president, like how, he doesn't pay taxes is because he does stuff like this. He's in the real estate profession, not just him, like all like your Grant Cardones and people like that. They can depreciate the property so much up front that this $893,000 can it go straight to their income, like whatever their job is, and offset that 100% dollar for dollar, because they're considered real estate professionals. I'm not gonna go too deep into that one, but that's something you should look into, what's called a real estate professional from the tax IRS standpoint. Essentially what it says is you have to work in the real estate business. That has to be your primary business. And you have to work more than 750 hours in it and work more than any other. Like if you had a side hustle, the real estate will have to be your primary part. And then you have to meet certain tests. One of them is you have to, what they call, materially participate in your rental property. So essentially you have to make decisions, for your rentals instead of having everything outsourced to a property manager. What that does is if you are considered a real estate professional, you can take these depreciation losses, which would normally be passive income, and treat them as non-passive. So this 893,000, if this was my data, like since I'm considered a real estate professional, I can take this and completely offset all of my earned income from my commissions, my realtor commissions. That's how people don't pay taxes at all. So it's a brilliant strategy. If you can become a real estate professional, even if you can't, all it's saying is that 893,000, it will be considered passive. And all I can use it for is to offset passive income and not earned income. So I would have to have passive losses to offset, passive income to offset, use the passive losses. So the reason I'm bringing it up is because, like, think about your people who invest in syndications. So whenever you're investing in syndication, like giving your money towards it, you're considered a limited partner. You're gonna get these, the cost segregation study is more times than not, it's gonna be done up front by the general partner, and they're gonna pass that depreciation on to you as the limited partner. However, just know it'll be treated as a passive loss, and you can only use it to offset passive income. You can't use that depreciation that they're gonna give to you and offset your W-2 job unless you're a real estate professional. And then you might still not be able to use it. So talk to your accountant to get all the rules. But the main reason I want to point this out is only to show that, like, the people that's like doing it, the Grant Cardones, people like that, they're utilizing this to their advantage to offset their earned income and not pay any tax. So that's the biggest benefit of depreciation. So just know that the amount you take, it directly reduces your taxable income, whether that's passive or not. And in the example I used earlier, let's just say that I'm making $500 a month on a property for that $6,000 for the year, and I'm taking that depreciation 364. So on my tax return, I would show a loss, that I lost money on the property, even though I really made $6,000 in cash. But from a tax return perspective, it's showing that I lost money. So that's the benefit of depreciation. You're basically shadowing money. Not shadowing money. You're basically not paying taxes on it. And here's something that's really key. If you don't take nothing else away from this, you got to take this right here. So if you never want to pay taxes, because remember I showed you, if you by the time you sell, I don't believe in selling properties at all. Like, I plan on keeping everything, passing it on to my kids. So, but if you ever decide to sell, Uncle Sam, they're gonna want that amount you've been depreciating all that time. They're gonna, recapture it and tax you on it eventually if you sell. However, there's something called the step up in basis. So as you can see on the screen here, the dad purchased the house in 1990. His basis for tax purposes is 100,000, but then he died. He left the house to the kids, and in 2020, 30 years later, the fair market value of the house is 500,000. So this is called step up in basis. The kids receive the property, and immediately they get it at the fair market value. So if they decide to sell the very next day, they're selling it at 500,000, and they're not going to pay any capital gains tax, as opposed to if the dad added them on the deed or gifted them the house, then they would receive his basis of 100,000 and have to pay a difference of 400,000. Well, a capital gains of 400,000. They have to pay taxes on that. So the main thing I'm trying to point here, the main message I'm trying to tell you here is, if you ever plan on giving property to your kids or whoever, heirs, don't put them on the deed. Make sure you have your estate plan and stuff in order and have it transferred directly to them upon your death, because they get that step up in basis immediately once you pass, and they can sell it the very next day, and they'll get whatever the fair market value is. That will be their basis instead of your basis. So let's see. So that's a summary. You must understand the rules of the game in order to win. Depreciation is definitely your friend. If you utilize it correctly, you could definitely win. Just imagine, like I showed you $6,364, which may not seem like a lot at all for a year, but just imagine when you have multiple properties and that stuff starts to compound. So just keep that in mind. Make sure that if you have rental properties, make sure that you're using an accountant or a CPA that fully understands this, because you could be leaving money on the table, literally, or just giving money away to the IRS. And I'm never a fan of that. I believe in taxes, but I don't believe in giving it away or giving them too much. So you definitely want to make sure you vet them out. If I encourage you, if you're not sure, if you've been doing this, to go back and look at your tax return. It'll be form 4592, I believe. It was on the screen. I forgot which one it was. Let's see. Yeah, I can't find it. I think it was 4582 or something. But anyway, just go back to your tax return and see if you claim depreciation. If you hadn't, it's not too late. You definitely need to do it though, because you're leaving money out there. And then, like I said, never sell. Ensure your estate's affairs are in order, so that way the property can transfer appropriately and they can receive your step up in basis instead of your original basis, and avoid having to pay all the capital gains tax. Any questions? That's all I have for you. I know it went kind of quick, but like I said, this topic could be a little confusion. Amy, you go ahead. I got you.
Hey, good evening. Thanks for this information. So my question is, can you think of an example where someone wouldn't want to use deflation, or is there ever an instance where someone wouldn't want to use it?
Nah, I can't think of any zero reasons why you wouldn't, because it's really no downfall to you. All you're doing is saving in the amount of money you got to hand over to the government.
Antonio, you mind if I jump in on that one?
Go ahead.
So the only time is if you need to show a certain level of income to qualify for a larger type of loan, and you don't want to reduce your income so much that it negates your ability to gain that loan. That's the only time. But just so you know, as if you have a good accountant, you have 3 years to claim depreciation. So for 1 year you don't claim it, and you say, I don't want to show that yet, you still have another year. Your account can go back and do what's called 1040X. Basically update your last tax return to say, oh, we forgot to do this depreciation. Now, I didn't say that. Talk to your accountant. I hold all, I deny all plausibility to the things that I said, but you have to understand, and something you'll hear Matt say, you got to choose your poison, right? Either you pay more in taxes so you can qualify for a loan, or you write off everything and you save money in taxes, but then you may have an issue with that kind of stuff. So you have to understand that game, and that's something you really have to have a great tax professional to guide you on the right steps, and you guys share your goals with them and saying, hey, this is what I want to do in the next year or two, and they should tell you what you should be doing or not doing in order to do that based on the income that you project you're going to make or have in that given time frame. That's the only caveat. But 99% of the time, write that bitch off. Pardon my French.
All right. Thank you guys for the information and for answering that question. Thanks.
Yep. I saw, I'm trying to monitor the chat. Is kind of hard. So I'll just keep going. Jamal or Harold, Tracy, if y'all can monitor the chat, because I can't do it.
Hey,
Now,
yeah, I got a question for you now. Where'd it go? It was, I'm sorry, lost it. Okay, here we go. Says, what happens if you put property in a trust and once person passes, the kids are now the trustees? What are the advantages of depreciation then?
So that's what I was showing on the last slide. So it would go to them and they would get it at the new fair market value. They don't take your old basis. So that's the benefit. You want to do it that way. That's why I was saying, make sure you get your estate plan and affairs in order. So that way they're capturing, the new basis at fair market value and not your old basis. Because you got to think about it. What if is you own the property for 20 years, 30 years? So I say 20 years, your basis is going to be really, really low compared to what the new fair market value of the property is. So just to avoid having to pay so much in capital gains, I would get the estate plan and stuff in order.
That is so important. I'm glad you're doing this, because people lose out. Like you said, they had a house 20, 30 years, and the whoever they left the property to lose out. They're paying taxes on all that stuff. So this is really good, important. And a lot of people, that is, having that trust is important also. But
I must reiterate, do not. I know you probably think if your parents gifted you the property, that's a good thing. Not necessarily, because once they gift you the property, then you get it at their basis. So anybody, not just your parents, I'm just saying, or add you to the deed. Don't do that. Just let it go the traditional, that you pass, and let your property, have your stuff set up to where that they get it, through being a beneficiary of your trust, or however you have it set up in your will, whatever.
Okay. And the next one is, how does depreciation recapture work in a seller financing deal where you pay the owner over time?
Coming from what side? Who you mean? Like when you say whoever said that? Can y'all speak up real quick?
Brian Davis.
Hello. Yeah, sorry about that. Yeah, so I was looking into a seller financing deal, and the owner was asking how his taxes would work on the seller financing side. So I was trying to give a little insight on that, if there is anything.
From the depreciation aspect, I'm not sure on that. I mean, as far as his taxes, he would only have to pay taxes on the interest earned that you pay him. Whatever y'all arrange the note, he's only paying tax. Instead of him, if you were to buy the property from him, he would have to pay taxes on whatever that amount is, like the total gain that he made off the sale. If he would have owned the financing to you, he would only have to pay taxes on the interest that you paid him each month, or for the year, I should say.
Who writes the depreciation off? Still the owner, right?
No, the buyer.
I ain't hear the question anyway. My bad.
Who gets to write the depreciation off? Oh, that's right, because there's no mortgage on it, so that's probably it.
So Brian the buyer would be the person, just like if just treat it as if it was a loan from a bank. You would be the buyer writing off the depreciation.
Yeah.
If you're renting it, not if you're living in it.
So that does save him on taxes then, since he doesn't have to pay on the full amount if I was to pay him the full amount in cash at one time.
Yeah, right. It'll be an installment loan. He just paying taxes on the interest earned from the loan.
Thank you.
Yep. Natalie, what up? What you got?
Hey, Antonio. Hey, everybody. I just want to make sure I understood your depreciation example, right? For the step-up basis. So if my parent left me their property and it transferred to me upon their death, right? And they paid $100,000 for the house 30 years ago, right? Now, if I go and sell the house, when I'm filing my taxes and I'm reporting the capital gain, you're saying my basis is going to be 100,000, like my parents was when they bought it, right?
No, I'm saying your basis would be whatever the fair market value of the property was when you took over, and you sell it. You don't have a capital gain. So let's just say you were saying it's worth 100,000. You say they paid 100,000.
Yeah, if my parent paid 100,000 for it, so their basis would be 100,000, right?
Well, if they paid 100,000 for it years ago, then their basis would not be 100,000. It'll be whatever it is at that point. So let's just use the real numbers, right? So let's say 20 years ago, your parents bought a house for $100,000, an investment property for $100,000. They've rented it out all this time. So 20 years have gone by. So they would have depreciated it by 27 and a half years. So what that's $2,750 a year. So so whatever that is times 20, that will be, let's just do the math, because 20 times 2750 is 2750 is 55,000. So that would be the depreciation they've taken in the 20 years, right? So that means their basis in the property is only 45,000 at that point. That's the 100 minus the 55 that they've taken in depreciation. So 20 years have passed by, and then they passed, and and the property is gone over to you, like through their estate planning. So your new basis will be whatever the fair market value is. If it's $300,000 at that point in time, then that's your basis. You're taking it over at 300,000. Sell the first day, you can sell it at 300,000, and you have a $0 capital gain, because your basis in the property is 300,000, as opposed to if they would have given you the property by gift or put you on a deed, you would have took over at that $45,000 basis, and that's not what you want.
Oh, in other words, I have more to depreciate from that point on, because I'm starting from 300,000 instead of 40,000.
No, you wouldn't be depreciating. You just getting it at a new fair market value. Like your basis is going to be whatever the fair market value is. So you're like in this case, you're selling the property. So it doesn't matter depreciation. Like we're not talking about that at that point. We're just talking about once you sell the property, what's your basis in the property at that point in time.
I think she's saying if she keeps it, she can start depreciating from that number.
Gotcha. Yeah.
If my basis is 45,000, right, then that means that I get taxed less. If my basis is 300,000, don't I get taxed more?
No. Okay, so let me break it down for you. When you're depreciating something, you're depreciating it at whatever value they're saying it's at, and you're taking a loss, quote unquote, that the property is deteriorating. That's what the tax code says. So when your parents bought at 100 grand and they depreciated down to 45, they took $60,000, quote unquote, off of it, right, for their tax purposes. You at 300,000, you're now saying when you get that step up basis at 300,000 or whatever the number is, you're like, okay, now I own at 300,000, and now this is what the fair market value is today. The clock resets itself for 27 and a half years, meaning starting at 300,000, I can now depreciate at that level. If once you don't want to take what your parents had because you would have nothing left to depreciate.
That's what I was asking. Is if I have a $300,000 basis, then I start depreciating from that amount. I think Antonio said no.
No, I understood you.
No, that's if you sell the property. If you sell the property, you don't owe any capital gains, but if you decide to keep it and it's still an investment property. Remember, it has to be an investment property. It can't be your personal house. It has to be investment property. You can now start depreciating from that cost basis. So if it's 300,000, that is where you're depreciating from.
Yep.
I got you. Got it.
I thought you were saying you were trying to sell it, so that's my bad. I understood you wrong.
I probably did say so. I think I did.
But yeah, and then, of course, we will say again, please refer to your tax professional for all guidance on these matters.
Yep.
And I do want to piggyback off of what Harold said. You do have 3 years from the original due date of your tax return to submit an amendment. So it doesn't have to be the following year per se that you make an adjustment. You have up to 3 years to go back and amend your tax return.
Yep. What's up, Will?
What's going on, Antonio? Thanks for the information. I really appreciate it. Question on how does that step up basis compare to any type of inheritance tax?
That I don't know the answer to that. Anybody want to chime in? I thought the inheritance tax was at a certain level, like a dollar value.
Yeah, I know that. I believe that is, and that we're just kind of putting the answer to my question with everybody's responses, right? So it's only on investment properties. So I get that. So, but if a person was to not get the property put in their name with a parent, like if I gave it to my children, then later on, once I passed, in my mind, it was like put them on the deed because it's theirs, or into a land trust, they're the beneficiary, they'll get that, as opposed to saying, hey, I'll keep it in my name, and then when I pass away, that's what you get. But then there's also a certain bracket or dollar amount by which is not taxable as inheritance, but I think above that, then it is taxable.
$12.06 million for this year.
Okay, there you go.
Yeah, I gotta get this.
Yeah, so anything below that number doesn't fall into that inheritance tax. But that's one of the reasons why when you hear us talking about trust and stuff like that, it is not subject to the inheritance tax, because you're not technically passing on an asset from one heir to another heir. You're passing the management of a trustee to another trustee in a vehicle that's protected from that. That's why you see a lot of people have trust and why they manage this stuff in trust. But if I were, as an individual, say I have over $12 million in assets, and I were to pass that on to my heirs, they are subject to anywhere between 18 to 40% of an inherent estate tax. So that's why you always hear estate planning, because if you don't put these things properly, your generations are gonna lose a majority of the work that you put in for whatever time you've been on this earth.
Okay, so the amount
that's
12 million.
Yeah, so for this year, I just looked it up. For this year's 12.06 million. If you have any assets above that, you start to pay inheritance tax on.
I'm being above that. Okay, I appreciate that, guys.
Yep.
Our pleasure.
Latricia, coming to you.
Hey, good evening, everybody.
Good evening.
I have a question. My sister and I purchased a home in New Orleans last year sometime, and we're just about to get started, like renovating the house. My question is, when we were talking about well, setting up insurance, you know, like to get the flood and fire and everything else, the agent was telling us that his houses in New Orleans, he have them like as a LLC. It's not in their name. So I'm like, should we take the house out of our name and put it in the LLC? I'm trying to see about the setup, you know, so we can start right with the tax purposes.
So from a tax standpoint, that don't matter. The LLC won't protect you from taxes. It's more from the legal, the litigation part. It's totally your call. I would talk with an attorney. If I were you, I'll tell you what I do. So with all my properties, I don't own them personally. I have LLCs that own them, and you can do that by way of, at this point, just transferring the deed to the LLC via a quick claim deed. And if you need help, you know, I'm in the area, so if you need help doing it, I can help you with it. It's easy and it's cheap. So
Yeah, and I'm sorry, I didn't want to cut you off.
you
Finish.
good?
Well, the house is paid for, we paid cash for it, but the loan, to get it renovated, we doing a loan. So
Right.
I don't know if if you deal with that as well, because I wanted to make sure that she's getting like the best interest rate, because it's in her, the loan is gonna be in her name, but we're gonna go half on the note for it.
Mhm.
But I don't know if
So here's the thing. So you have two options. So
okay.
because the property is currently under her name or your name.
It's in both, the property is in both of our names, but the loan to renovate is going to be in her name.
Well, here's the thing. Who's she getting the loan from?
Gulf Coast Bank.
Okay, no, the reason I say that is because a lot of times if you're on the deed, they're gonna require both of you to be on the loan.
Okay.
And so unless this is a investment loan, like from a hard money lender or a private lender, they may not require that. They may just say who's the majority owner, and they'll do that. But typically they're gonna want you to have an LLC for them to be able to lend to you. You know what I mean? So that's the piece that you gotta kind of figure out. And that's why you should definitely talk to an attorney just to figure out kind of the logistics of that.
Okay.
You can email me or Antonio, and we can kind of maybe offline walk you through the process so we can understand it a little bit better, because
Okay,
we don't want to
great.
guide you the wrong way. But then we would suggest you talk to like the quick claim deed. If you got to do that, it's very simple, like he said, particularly in a state like Louisiana. And that'll allow you to work with the private lenders without any issues. You'll probably still be personally responsible for the loan, but it will still be, but it'll be under the business name.
Okay. How can I can get your contact information?
Look,
Yeah, hold
you're right.
on.
I'm about to
Well,
say,
I know
you can scan my thing.
Antonio say IG, but what about?
Yeah, you can scan his thing. He's high tech right now. I'll put my contacts in here. Usually I'm used to Dan, just by the time we finish talking, it's already up here.
Right. Uh-huh.
But hold on, I'm putting, yeah.
Keep putting this in there. You can hit me up 504-220-7297. 504-220-7297.
All right. Thank y'all.
Yep. All right, Vincent, coming to you.
All right, appreciate it. Thanks for the information and time, guys. I think some of my questions got answered, but let me just kind of recap a couple of things to make sure I'm tracking with you. So first question is you talked about your properties are in LLCs. So how does that work, with the step-up basis, being that it's in the LLC? You just transfer that to the trust and it doesn't impact anything?
That's a good question. To be honest, that one kind of got me. I don't know if I know the answer to that one, and I don't want to tell you the wrong thing.
It's you're gonna put it all in the trust. Everything is gonna go in the trust.
Okay, so.
Yeah, and one of the things, again, make sure you get a good attorney to set that up properly, so they set up the rules properly, and that it doesn't screw up when the transfer happens, that it creates any tax liabilities or anything that creates an issue for the next person taking over.
Right. And then my second question is probably going to be best to give you an example. So one of the examples you used, Antonio, was So, or I think the other lady earlier asked, so let's say, for example, my parents have a property, it was their primary property, they passed, they send it to the trust, it comes to me, and I decide I want to turn it into a rental property. Does it still qualify for the step up, even though it was their primary residence, but now I want to use it as an investment property?
Well, you would just be getting it at whatever the value is. So yes, essentially, I guess you wouldn't call it necessarily a step up if they didn't use it, because they didn't use it from a rental property perspective at all, right?
Right.
Okay, so yeah, you would just start whatever the value of the property is when you get it. That's where you would start taking your depreciation from, if you're putting it into service for rental property use.
Got it. Okay, cool. Thank you.
No, and just so you know, it is technically still a step up because as the heir, you're no longer in, like, so let's say, for instance, like he said, had they put you on the deed, you would have had their cost basis. So whenever you decide to sell it and or for tax purposes, you would be liable for the taxes. But because they're giving it to you after passing, you do get the step up, meaning like you get the cost basis at the time of their death.
Gotcha.
So,
Man,
so either which way, and then when you decide to make it an investment property, now you have the option to depreciate from that point forward, as long as you delineate it as a investment property on your taxes.
Gotcha. No, man, this is a real gem, man. A lot of people lose a lot of property that way. This is a big one. Appreciate that.